Hi, everyone. Thanks for joining us today. We're going to be starting in just a few minutes. Meanwhile, we recommend for the best user experience for the Zoom meeting that you click on the upper right-hand view and choose speaker. Hi, everyone. Thanks for being here today. We're going to start in just a few minutes. In the meantime, we recommend for the best user experience for this Zoom meeting is to click on the upper right-hand side of your Zoom screen and choose the speaker view. We'll be starting in just a few. Hi, everyone. Thanks for joining us today. While we're waiting to get started, I'm going to go ahead and launch a poll that asks a little bit about legacy gift giving. And then afterwards, we will start briefly. Hello, everyone. Thanks for joining us today on this rainy afternoon. We're going to start the meeting shortly, but in the meantime, we've launched a poll that we've asked for you to participate in if you care to do so. Just a reminder, we're going to be recording this call today. Also, we encourage your questions and we invite you to use the chats to type your questions throughout the presentation. Or if you'd like to wait until the end of the presentation and ask your question in person, you can do that by using the reaction button on the bottom right of your screen and raise your hand. And when you do that, we will bring you to the virtual stage so you can ask your question directly to our hosts. Thanks again for those of you that participated in our poll about legacy gift giving to ECF. If you're interested in learning more, you can always contact Joy Anissa Russell. Her email is russell@evanstonforever.org. We're going to go ahead and start the meeting now. So please welcome Saul Anderson, President and CEO of ECF.
Hello, good afternoon, good evening. Thank you all for joining us for our 2022 investment briefing. This group really represents some of ECF's most trusted partners. Not only are you the donors, current and former board members, program partners, fund holders who really help us do the work of creating a vibrant, inclusive, and equitable Evanston, but you also entrust us with your resources, with your funds to be able to leverage those appropriately in the community. We do not take that trust lightly, nor do we take it for granted. And so it's very important for us to share this information and talk with you a little bit about how we're, utilizing those funds, how we're investing them, how we're using those funds to build the best Evanston that we can possibly help to be a part of. So I'm excited to share for us to share a little bit of detail and answer some of your questions this evening. And talk about, as I said before, more about how we're stewarding the funds that you entrust us with. So at this time, I'm going to pass the virtual microphone to our board member and board treasurer, Matt Feldman.
Thank you, Saul. Welcome, everyone. As Saul said, I'm a member of the board and the treasurer of the Evanston Community Foundation, and we are here to report to you on how the stewardship of the investments that are our responsibility has proceeded over the year. This slide, I think, depicts two things that I want to point out. One is the point that we focus on helping Evanston thrive forever. Now, that's a very long time and a very important role, and one we take quite seriously. We think of it in terms of sustainability, and you'll see as our highly capable chair of the Investment Council, Ralph Siegel, discusses what we have done in the Investment Council to preserve the value and grow the value of the portfolio over time, that we have excellent performance even in challenging times. The other important point, and it's one that I been particularly cognizant of as I've served on the board is the centrality of the role that ECF plays in Evanston, both as a trusted place for donors to provide resources to ECF so that we can support nonprofits, and through the role that we play in terms of guiding those nonprofits and advising them and providing funding. There's a critical resource that we think Evanston benefits from tremendously, and our goal on the board is to assure that that continues well into the future. Jan, if I could move one slide, please. We talk about the portfolio when we have our investment discussions because it is made up of a number of components, and I'll show you in a moment what that means. But we have donors like yourselves who have provided us with funds so that we can serve Evanston's nonprofits and help the donors realize your goals for the various nonprofits in Evanston. We also manage money on behalf of other nonprofit organizations who entrust us with their endowments so that they can see their principal and its value grow so that it can support their initiatives and their programs in the city. And then, of course, the endowment that is unrestricted for ECF also provides value for us to use for grants and to support our own operations. And Jan, if you could move to the next slide. This illustration shows just how many portions of this portfolio are broken out into various components. For example, field of interest funds are ordinarily done through the Community Works program, and that's the largest component of that. And we can devote our work there through grants and initiatives to early childhood and workforce development and land use protection. ECF has unrestricted funds, as I've mentioned before, that we can use for grants and operations. We have other endowments from a number of organizations across the city and donor advised funds. So there are a lot of various components here that make up this large portfolio, all of which is managed as a single portfolio to the benefit of everyone. Jan, one more slide, please. So we also have a unique management structure. The investment council of ECF that is managing this portfolio is an all volunteer asset management function. And it's, as you can see, managed by a group of people who give their time and their talent, and there is considerable talent involved in the world of asset management. So these are people who not only understand how to manage the portfolio, but have, as Ralph will show you shortly, an outstanding track record in doing so. And invariably, when I'm presenting this, I call attention to the bottom, where the number of years associated with the investment council is now at 357, which is cumulative, I am pleased to say. And with that, I am going to turn it over to Ralph Siegel, our chair.
Thank you, Matt. Welcome to everybody. I am sure you could tell by this picture that I don't look a day over 300, so I'm pleased by that. Were I able to look out at the audience, I'm sure there would be a number of familiar faces that I would be seeing. This is, I think, the 5th or the 6th, and Jan, who knows everything about numbers associated with the Community Foundation, will correct me if I'm wrong on that in the chat. But we've set these up largely because we want to report to you, our various constituencies, who have, as Matt said, to whom you've entrusted this, from whom we have money that we're investing that we've been entrusted with. And we want to report to you as much as we would report to any of our other constituencies. I would also like, before I get going, to throw a particular shout out to my colleagues on the council. As many of you may know, what I do for the council is basically what I do in my daytime job. And I can tell you that if I had clients, particularly of institutional clients, that were like the committee that is assembled, that's working on your behalf, professionally, I would truly be a more happy camper than I am now, because the talent, the thoughtfulness, and the care and the interest that all of them show in what we do is really, professionally, to me, striking. I'm reporting on their behalf, and you can know that this is truly a collective effort. I'm going to start by framing 2021 and to put it a little bit into context. Many of you have seen a chart that is familiar to this. I happen to call it a patch quilt chart. If your eyes are a whole lot better than mine, you can see the legend at the bottom as to what every different color represents. But each one is a separate asset class, and they are arrayed from left to right by years. Each of the columns is a year going back to 1994. And across the center, we've anchored the chart, or this assembly, at 0. So everything on the top half of the chart is a year in which a particular asset class had a positive return, ranked from best to worst. And at the bottom, you can see that those that didn't do so well. Last year was one of those very remarkable years, equivalent really only to 05, let's see, 03, 2003, 04, and 05, and 06, where we had no returns except one that were less than 0 last year. Everything in terms of financial assets did well. And if you go back to 2020, actually I missed 2019 in there, but the last 10 years, since the end of the great financial crisis, or the subprime housing crisis, however you want to phrase it, came about, with the exception of 2018, it's been a wonderful decade for financial assets. Next slide, Jan. How did we do in the context of that, where it was very easy to make money, if you will? We began the year with 32 million. Funds came in of 1,061,000, and funds were taken out of 1,102,000. And to get back, and to echo the refrain that Matt offered, we don't, from our point of view, who put money in and who took money out are really of not a concern to the council. We are just investing the portfolio, the funds that we have available to us. It's a very highly focused view, if you will. From an investment point of view, we adjust on a monthly basis the timing of the inflows and the outflows. That gives us an adjusted value of 32,195,000 to work with. And at the end of the year, that amount was 37,038,000. There was a gain of investment value of 4.8 million, and time-weighted return adjusted for the cash flows, the return was 15%. At this point, one of the things that you're going to ask is, okay, Was that any good or not? And we're going to talk about that in a little as we go along. We're going to talk to you about the metrics that we've used. And I've probably been doing this now long enough that there are going to be some of you who will be able to sing along with me as I go through those parts of the presentation. I hope you'll endure it for the benefit of those that might not have heard it. But as a first pass, let's do this. Let's break down the portfolio by asset categories. First one is cash. We, as a practical matter, do not assign any allocation to cash. We know there will be some, but we are a long-term portfolio. It's an endowment. We have an investment horizon, and we're not very good at market timing, to be very candid, so that we're not targeting any allocation to cash because we're not planning on moving in or out. It's not part of the investment process. Over the last 5 years, or last year, cash in the form of 90-day treasury bills returned 5 basis points. If you're not familiar with the basis point, it's 1/100%. Think of it this way: if you had invested $100 in T-bills in 2021, you would have earned a nickel for the year. For the last 3 years, annually, you would have earned a little bit over 1%. It's not a way that you're going to get rich quick. In the domestic fixed income group, the benchmark that we're looking at is the Barclays Aggregate Bond Index. It is a measure of all of the bonds that are publicly traded in the United States, treasuries, mortgages, corporate bonds of all varieties, in all of an investment grade. Last year was probably the third or the fourth time, if I recall properly, in which bonds produced a negative return for the year in 2021. Why did they produce a negative return? Because in measuring the return from a bond, you count the coupon, whatever you earned on that, and then you add or subtract from that the change in market value from the beginning of the year to the end of the year. And you may say to yourself, but I'm not going to sell the bond. And if I don't sell the bond, I haven't taken a loss, have I? And the short answer is no, you haven't realized a loss. But as a practical matter, there's an opportunity that you've passed or foregone on the table because the price of those bonds has gone down. And there's something else that we could have done. For our part, we earned 4 basis points. And if you'll remember back to what that meant about about treasury bills, you'll say that's not very much, but it's better than losing money. Similarly, over the last 3 years, the index has returned about 4.8%. We've returned 4.4% per year. There's some reasons for the differences in that, but they're really not very wide right here. I could take some time, but it really wouldn't be of interest to you. But if you look at the next level of asset category, foreign fixed income, we made a judgment last February when we looked at the state of the investment grade market for bonds outside the United States. And at that point in time, there was about 15 or 16 trillion of sovereign debt, which is part of that benchmark, that was trading at a negative yield. And that is something that really should not exist in finance. It's a real anomaly. I learned in business school, it was also almost an impossibility. And they would cite as examples for 2 months during the Great Depression, treasury bills traded at a negative value. But here you've got sovereign debt running out 10 plus years in Germany, in Japan, and the like, where the returns were negative. We said to ourselves, we do not want to be in the business of investing in assets where we know going into it, it costs us to be there. So we took the asset allocation in global fixed income to zero. That paid off because that benchmark was down about 8% for the year. Again, for the last 3 years, because we've been slightly risk averse as we have been in domestic fixed income, it was slightly behind the benchmark. But my guess is that by the time we talk next year, that won't be, the 3-year returns will look a whole lot, relative returns will look better. Next slide, Jan. Domestic equities. Here we could range between 30 and 65%. We're talking about the serious part of the portfolio. We have a current estimate, or had at the end of the year, a 52% allocation. Our return was about 26, little less than 26.5% for the year. Our benchmark, which is the Wilshire 5000, which is a broad array of domestic stocks, was up a little bit more than 26.5, 26.7. For the last 3 years, the return's a little bit different, but there are some valuation aspects to what we were trying to do, or what we were trying to express in our conversations in the council. That gap is closing. Conversely, in foreign equities, where our allocation is 15%, we had a better year in 2021, up 13.7 versus up 12.6. And for the last 3 years, we've been up 15.6 versus 14.8. Finally, let me hold on this one. The blend, well, no, I'm sorry, I'll be coming up to it in a moment. Other is or alternatives is a collection of investments that we believe have different risk and reward profiles than do traditional stocks and traditional bonds. And the reason that we have an allocation, or want to have an allocation, in other is because we have found there's a lot of work that's been done that indicates that if you introduce alternatives into a portfolio, you improve the risk reward profile of the overall portfolio. And what I mean by that is that you either take on less risk for the same return, or for the same risk, you get a better return. It's a more efficient way of running a portfolio, and we blend in, at this point, about 10% up to a maximum of 20. About 2 years ago, the foundation portfolio crossed 25 million. And that's an important number because for a not-for-profit, having more than 25 million opens you up to the realm, the opportunity to participate as a super accredited investor in the world of private equity, private investments, things that don't trade on an exchange. So we can consider venture capital, we can consider private equity, we can consider real estate, a whole array of investments that have opened up to us. We have devised or thought through a change in the allocation range that we'll be applying for the illiquid part of the portfolio. But we have a couple of investments in there, and you will see that the return last year was about 20% for the year. And for the last 3 years, it's actually been the best part of the portfolio. It's up about 18.9%. The benchmark for other is basically a constructed benchmark, which consists of the consumer price index plus 5%. It's just, if you're not going to be investing in stocks or bonds, you ought to be at least compensated with what you think the portfolio ought to be earning otherwise, which is 5%, and do it on an inflation adjusted basis, which is how we think of everybody, all the other investments, or how we think about the spending policy, excuse me. The total account, therefore, for the year was up 15.03%. As I mentioned, for the last 3 years, that's been about 15.8%. Our blended benchmark, and we actually had a question that anticipated this from people, the blended benchmark is basically each of the index benchmarks that you see above, for example, the Wilshire 5000 or the ACWI All Country World Index ex-US from MSCI of 12.6, weighted by the midpoint of the allocation range. And that's constructed. It comes up to 14.25% for the year, 13.4% for the last 3 years. The portfolio has done better than that. And then we've added another reference line into this page, which we haven't had to do for a long number of years because it really hasn't been a factor. And that is we're tracking inflation right now. So for calendar 21, lagged by a month, November to November, because of the timing of when the information comes out, the CPI was up 6.7%. For the 3 years, it was up 3.1%. Hold on to that 6.7, if you will, for a moment, because I'll come back and talk about it in a few slides. You want to go up to the next one, Jan? This one, we've met quarterly. We meet quarterly 4 times a year. Once last year and once already this year, we've had an extraordinary telephone meeting, one to make one change. It was the one on the, trying to remember what it was. It might have been the foreign debt, but I'm not sure. But this year we've already had an off-cycle meeting to approve an investment that we want to, where the closing is going to be in 2 weeks. It's one of the illiquid assets that I talked about, and there was a need to act on a timely basis. We did. The committee is very flexible and responsive to meeting irregular meeting dates. That said, it's not like we're meeting, whether it's a special meeting or not, and we're buying this and selling that and trading a lot. Our turnover ratio is all of about 12% for the year. It's very, very low. You can see in the chart that's above, we only added 3 new investments to the portfolio. We sold 3. We had funds that we added to 3 more, funds that we took out from 2 others. This is not a fund that trades very actively, and that's by design, not by indifference. Drilling in a little bit, in the next couple of slides, we'll get down to that. If you look at the portfolio, getting a little bit deeper than stocks or bonds or foreign stocks or alternatives, we're breaking it down a little bit more than that. I'm going to leave this one to the record for you. The next page in, Jan. We'll get to the more important question that I had referenced before, and you've actually gotten a little bit of a preview to already. And that is for us to ask ourselves, how are we doing? And the short answer is there are 4 different ways that we think a portfolio could be evaluated. The first one, and if you absolutely forced me to pick one of these 4, the first one is the one that I would pick, which is how is the portfolio doing in meeting the needs and the objectives and the targets of its clientele, the owners of the capital. And that is how are we doing compared to our spending target. We're going to show you an answer to that shortly. The second one we've also showed you a little bit of, how are we doing against the markets, the passive indices? How are we doing if we had just bought index funds, if you will? The third measure is how are we doing against our peers? And in this regard, we're very fortunate. We have a peer set that we can compare to. The Council on Foundations, which is a national collection of community foundations and the like, publishes a lot of data, some of which is measured by asset levels, assets under management. So we have actually a very robust set of data to compare ourselves to against our peers. And then the fourth one is to ask ourselves, how are we doing relative to the risks that we're taking? And I'll pause for a moment here just to go back to the comment that I made earlier when we were talking about bonds and the question of the investor who says, I don't care about market changes in a bond. As long as I know the company is good and it's going to pay the coupon and then pay me back 100 cents on the dollar when it matures, what do I care if it goes up or down? And the answer is, if you are a portfolio in distribution, which is like the foundation, then you care a lot because you're measuring price changes, market value changes to determine what your spending target is going to be. After all, we measure the spending target as being a 3-year moving average of the market value of the foundation. And that sets our target for how much money is going to come out. The less volatility, the better. And again, you may say, I'm not the whole foundation, I'm just my portion of it. And the fact of the matter is the concept is the same. The less volatility in the value of your particular fund, the more comfortable you can be in doing budgeting for the next year, that you're not going to see a highly volatile, a much changed distribution from the foundation for the following year. So first one, how have we done against our spending target? And what this bar chart shows you, the gray line at the bottom is the spending target, which the investment council recommends to the full board. And that is that is a number. If you look at that line very carefully, you'll see there's a remarkably consistency at 5%. And no, that's not an optical illusion. It actually has been 5% going all the way back to 1990. And the spending rule that we use, for those of you who are not familiar with it, is that we will we will recommend a spending rate equal to the increase in consumer price index from last year to this year, subject to a floor of 3%, 3.5%, and a ceiling of 6%. So anywhere inside that 3.5% to 6% range will be the target. For 2021, it's actually going to be up because CPI, as you saw, was 6%. So we've got that. The red lines are what inflation has run. And you can see that in the box, 75% of the time, the return that the foundation has earned has exceeded the spending target adjusted for inflation. We've been able to generate a real return for the fund. And in a higher percentage, 27 out of 32 times over the rolling 3-year periods, we have exceeded just the 5% spending target. We may not have done it on a real basis, but that is probably about 80% of the time in that second calculation. So that's our first benchmark. How have we done against our target? How have we done against the market? And what you could see is we've got data here going back to 1988. And in that period, the portfolio has earned net of fees 9.14%. The blended benchmark is up in that period 8.7%. The spending target plus the CPI, so the real draw from the portfolio, has been about 7.4% a year. Some of those numbers may not look like large differences in percentages to you, but you may have heard over time the reference that compounding is the 8th great wonder of the world. And if you look on the far right index, you'll see that the spending target going from 1988 compounding at 7.2%, you increase the value of what you've got by tenfold. You go up 1,000%. Going up 9.14% gets you up 1,900%. It's a big gap. It's one that we are, I would say, acutely conscious of, acutely proud of, and acutely interested in recognizing that we have to preserve that gap which we've created. We are creating a bigger and bigger hurdle for ourselves, but we think we can take it. Okay, next, the third benchmark. This is against our active peers, Council on Foundations. So you can see our return for the last 3 years, last year, 3 years, 5 years, and 10 years. And then we compare that against all community foundations. And then we compare ourselves against community foundations in our peer group, which is the $25 to $50 million range. And remarkably, you will see that for the 1 year and the 3 year period, the community foundations in our peer group have done better than we have. And I say remarkable because it usually doesn't happen. But my instinct here is that the ones who are already in this category have a larger exposure to alternatives, particularly the illiquid kind, than we have. We've just gotten into it. And the last several years have been exceedingly good ones for private illiquid investments. For the 5 years and the 10 years, you will see against our peer group, we compare favorably. And we actually do a whole lot better against the whole array of community foundations, which includes the billion-dollar ones, as well as the ones under 25 million as well. So all in all, we're holding our own to doing better as far as we're seeing it. But everybody within the world of community foundations in the last 10 years has participated in the strong market for financial assets that has existed, that's been in existence. The fourth one, which is how are we doing against risks that we're taking? There are a lot of boxes. And what I'd like you to do is to find the one that is turquoise, or it's green, depending on how acutely sensitive you are to colors. It's labeled the 90-day treasury bill. And if you could mentally draw a line from the treasury bill up through the center of the box, the dark blue box that's labeled ECF portfolio. That is what's known in the world of finance as the efficient frontier. And what that means is if you look on the vertical axis, you'll see rates of return starting at 0 and going all the way up to 12%. If you look on the horizontal axis, you'll see the standard deviation of those returns. And if you're not statistically minded, all that measures is how volatile the return series is. The higher the standard deviation, the more gyration up and down there is. Actually, the best way to view this return is to say to yourself, Northwest is best. In other words, Jan, if you put the cursor up at 12%, if you could earn a 12% return with no volatility, it would be a straight line sloping up at 12%. That would be the best thing that you could do. So that's why I asked for an imaginary line to be drawn between treasury bills, which are defined as the risk-free assets, and our portfolio. Everything to the right of that is less efficient than what we've done. And the numbers that you see in there in parentheses are what is known as the Sharpe ratios. And Robert Sharpe was at the University of Chicago in their finance department when he did the work on this. And he said, I want to measure the return that something earns, the excess return over the risk-free rate, adjusted for the standard deviation. So in other words, it's really saying, how much of a bang for the buck did I get? How much return did I get for the risk that I took? You can take a lot of risk and earn a lot of return, but you are doing so for taking on more risk than your client might want. And we've always believed that if you are a long-term portfolio, and an endowment by definition has a long-term investment horizon, it looks out indefinitely. We think that downside protection is a whole lot easier than trying to make a lot of money quick. And think about it this way. If I tell you one year you're up 50% and the next year you're down 50%, you're not at a break even, because to flesh that out, if you go down, if you have $1 and you go up 50%, you have $1.50. And if from there you go down 50%, you have 75 cents. You're not back at break even. The same thing is true if you do it at 10%. You're not at break even, but you're at 99 cents. You're a whole lot closer. Or another colloquial way of saying it might be to say, we're not trying to hit home runs. We're perfectly content hitting singles and doubles as long as we don't strike out a lot. And so for our purposes, running a portfolio that thinks a lot about downside leads us to a more efficient portfolio. And what we found is that if we spend our time worrying about the downside, the upside tends to take care of itself. It doesn't need our help. Thank you. You're going to see that on the next slide, I think, Jan. Yeah. And what this slide is showing you is how the portfolio has done relative to simply the asset of choice, the stock market, the S&P 500, for the last 20 years. And you'll get a sense of this upside or this risk control capture. And we have a lot of data, as you noted earlier. We can tell you what the return was going back to 1988. But to do this calculation, we really only can start in early 2000. But what I want to do is focus on September of 2000, which is when the stock market bottomed and a market cycle began. And that market cycle ended in February of 2009. What I mean by a cycle is the market went from a bottom to a top and then down to a bottom again. So let's look at just that 7-year period. The market was down 1.4% a year if you look at the table at the top of the page. We were up 2.9%. In the months where the market was up, we were up more than the market. We were up 1.27%. That's surprisingly good. But when the market went down, and this is the important one, when the market went down, we didn't go down quite as much as the market did. The beta, which is a measure of volatility of the portfolio, was not very much greater than the stock market. And keep in mind, we own stocks and bonds and foreign stocks and alternatives in there. It really wasn't a wild swingy portfolio. And you could see while the S&P had a negative Sharpe ratio in this period, ours was a little bit positive. But the important point in looking at Sharpe ratios is that you want to be higher than the alternative. Any number greater than the alternative is a more efficient portfolio. Another cycle began in 2009, where the first one ended, and ran until the pandemic, the first quarter of 2020, in the throes of the pandemic. The market was up 15.7%. We were up only 12.4%. And you might say, you left a lot of money on the table, didn't you? And the answer is, yeah, but look at the upside and downside capture rate. We were up in the months, we weren't up as much as the market was up, but the percentage by which we were up was greater than the percentage by which we were down in the markets was down. And if that ratio is over 1, you are in good shape. And our beta, we were not very volatile to the market at all, less than 1/2. And as you might expect, the Sharpe ratio was 1.3 versus 1.14. We were providing the return that we needed to for the portfolio without taking a whole lot of risk by being concentrated in a more volatile asset like the stock market. Since March of 2020 until now, there are some things that are a little bit wacky here. We're up, we're not as much as the market. And the upside downside capture is not, the relationship is not in line. As a result, our Sharpe ratio is a little bit behind that of the market. But if you look at the beginning of if you look through any of these cycle periods, you could see periods where the portfolio was not behaving exactly in line. We've got time. We know what we're doing. We haven't changed the policy. It's worked for more than 35 years, and we're just sitting with it right now. We're content to do what we know how to do and see what happens. A couple of more slides, and then we'll have time for questions, because I know I've been talking a lot and you might have some. This particular slide focuses on just the mutual funds and the exchange traded funds in the portfolio. So whether they're actively managed or ETFs, the one number I want to point out to you is under fees and expenses, bottom half of the page. There are the weighted average expense. It's a white line in there, is 48/100%, 48 basis points, and that's cheap. Just take it from me. That is a very low expense ratio for a portfolio that contains stocks, international stocks, and alternatives. It's $154,000 of fees that's all being paid above the line. In other words, those fees are assessed by the funds before we see the return. But if you really want to get a sense of what the council has brought to the foundation, and you say, had we hired an external consultant to do what we've done, it would be in the range of about $125,000 to $175,000 a year the foundation would be paying for this service that is left available to be reinvested back in Evanston. I think, Jan, we're coming to the end. Yep, I just gave you those numbers just now. I should mention the below the line expense ratio that we charge, the foundation charges. This is 100 basis points, but this is being reinvested, as I said before, back into Evanston to support our activities and defray the costs of providing the accounting and the infrastructure. And I think that is the last page in the formal remarks, because 20 and 21 and maybe 22 break out, all of the specific investments that are in the portfolio as of December 31st. So, time for questions. I have stunned you all into silence.
I'm going to add that folks can enter their questions in the chat, or if you'd like to raise your hand using the reaction button, we can bring you onto the virtual stage and you can ask Ralph and Matt your questions directly.
There's a question, Dorothy. Can you unmute?
Yeah.
Hello.
Hi, how are you?
Well, how are you?
Good, good, good. I'm wondering, will your investments be how can I, wait a minute. Will the war affect any of the investments that you're doing? Will if this war is long term, are you investing in anything that will be adversely affected by that?
Well, none of the, I've checked on the international investments and there are going to be some companies in some of the international funds that will have operations in Russia or the Ukraine. They're not extensive right now. I can tell you for all of the domestic equities in the portfolio, the exposure to Russia or the Ukraine is about 1% of their activities. And that was calculated based on 2021 data, which means it doesn't reflect the number of companies that have announced that they've ceased operations in Russia or are not Ukraine, but it's not been a large market for them. To be sure, there are going to be a huge amount of consequences from the war, not the least of which is the increase in energy prices, and that's going to affect Europe substantially, not so much the United States. Wars are costly, wars are expensive, and wars cost money. We are to fully answer your question, it's one of the things we're going through to make sure before the quarter ends that we make sure we know where our exposures, if they are, where they are, and if they are, how big they are, and decide whether or not those are funds we want to stay in. So that'll be one of the questions on the agenda that we have for the April meeting. Did I get at everything that you were wondering about, or did I miss part of it? Okay, thank you.
Ralph, there's a question in the chats. How does the council decide to discontinue a fund?
That is a very good question. When we meet quarterly, one of the things that we've done is to have reviewed the portfolio. There is a small working subcommittee of 5 that are all presently active in the investment realm right now. We will discuss thoughts about that and develop a recommended program. It's an agenda item then for the entire council, and it becomes the subject of discussion. And I think that one of my jobs in running those meetings is to make sure everybody voices an opinion on it, and we have a vote, and that's the decision. If there's something that happened with one of our holdings that required immediate action, we would send out an email basically laying out the investment case for getting rid of it right now, and we could do that tomorrow if we had to. It's a very flexible and responsive, as I say, group. I should also add, and I didn't mention this in the remarks, the council operates under an investment and spending policy statement that's reaffirmed by the board every year. And that basically is our marching orders so that we can't come up with a portfolio that is our idea of what a really excellent portfolio might look like. The board, who is the fiduciary for the fund, after all, says, here are the guidelines that in which you need to operate. And I've always been a believer that those guidelines are there for the client's own protection. They protect you when you're terribly pessimistic and you think the world's going to end. It forces you from selling everything. And correspondingly, when you're highly enthusiastic, it keeps you from buying too much. So we adhere to them. They're important, and we follow them. They're
Ralph?
reviewed every year and reaffirmed by the board.
It looks like David Ellis has a question.
Yes.
Yes, I do. A few years ago, Ralph, I asked about the way the draw is computed, in that it's, for some of us, possibly the most important figure of the year. It's based on a 3-point average of 3-year ends. Yet my understanding is a lot of your decisions internally are based on like monthly average, month-end periods, or probably quarter-end periods. And I just wanted to know, I thought you guys were going to take it up. I just would say that if our draw was based on quarter ends, it would reduce our volatility, which is a constant theme of the whole presentation.
I remember our conversation on that one well, David, and I'm going to leave this one to Jan, but I do think, I won't anticipate the answer, but Jan, did we change the calculation to a rolling 12 quarter?
We did not change to quarters because we previously didn't have the capacity, but we should revisit it because we now do have the capacity, if that's something everyone thinks is prudent.
Thank you. I do think it's prudent.
There's another question. Looks like it's from Linda Gerber. In the uncertainty of 2022, what do you expect returns this year to yield?
If I knew the answer to that, I and the council would be speaking to you via satellite from our yacht someplace in warm water. I would take the whole council there because it wouldn't cost very much. And on a 300-foot yacht, there's room for all 12 of us, not to get in each other's way. But that said, to be very honest, Linda, I have no clue. And I think anybody who tells you they do is kidding themselves, and more importantly, you. We're targeting, I guess the best answer I can give you is we've hit in the range of 5 to 10% for a number of years. I think the last decade set of returns are going to be very hard to replicate. It may be that we've had sort of the biblical story of 10 fat years and we need some lean years coming. But I have no clue whether or not there's any merit in there or not. I'm sorry.
Richard Gottardi asks, where will inflation in 10-year one rate be? Sorry, that.
I don't know, but on that one, I could share the wisdom of crowds with you, because if you look at the 5-year forward, I'm going to get technical here for just a second, and I'll even explain what I mean. But if you look at the 10-year forward yield on tips, the inflation assumption is under 3% right now. There are a class of US Treasury securities that are referred to by an acronym TIP, and it stands for Treasury Inflation Protected Security. And the way these things work is for whatever the CPI does in a given month, at the end of when the bond matures, the government gives you an extra $1,000 a par or $100 a par, excuse me. So that if inflation is 10%, you'll get an extra $1,000 face amount when you mature. There is an active market in the forward trying to estimate that for forward delivery, much like on the commodities exchange, a baker will buy wheat for delivery in a year out. You can, as an investor, buy tips for delivery 5 years out, 10 years out. And the estimates right now, the market thinks the 1 year delivery is probably about 5%. The 3 year is about, no, I'm sorry. The 1 year is about 7%. The 3 year is about 5%. And the 5 year in there, it flattens out, is around 2-3%. And an estimate of a lot of people is much better than one person's.
Another question, how much turnover is there in board membership?
So
Are you talking about the board or are you talking about the council? To the questioner.
That was from Jerry Hurst and Julie. They say council.
Back to you, Ralph.
Can you come back, Jan, to that page? What was it, page 4, page 5? Or is it? I'm not sure who is running the screen.
I think it's 4.
4, yeah. If we can find that page and bring it up, and you have to tell me if it's up, because I can't.
I think Jan's working on it. Yep.
Okay. There you go. Can we enlarge? There you go. Does everybody see that enlarged? Here, I will. If you can see that, you can see that we had people that we added as recently. I think Laura Min and Matt may have been the most recent ads in 2019. Being on the council, Jerry, is sort of like being in Hotel California. You can come in, but if you're good, particularly, we won't let you leave. And as a matter of fact, for those of you who are wondering why we are the council instead of the committee, originally the investment committee was a standing committee of the board, but because we found good people whose talents and skills and volunteer activity we wanted to tap, we kept adding. Illinois law requires that there be an equal number, at least an equal number of board members to outside members. And we crossed the line somewhere. I think it was when John McCarthy's term as treasurer ended. And we had to, we then dissolved, the board decided to dissolve the committee. And I think Michael Brody had a lot to do with this one. And we reconstituted it as a council. But if you're good, we saw no reason to retire you. We won't let you go. Anything else? Thank you, Jan.
I think there was a comment from Michael Neighbors in the chat. Wondering if this was considered a good year this past year.
Yeah, I would consider it a good year. We beat our bogey. We beat 3 of our bogeys. So yeah, I'd say it's good.
And Ralph, the
I wanna
second part of that
clarify.
comment was whether or not that was true for everyone. And I think we should clarify that all of the funds are invested as one single
Oh, yeah.
fund. We
Yeah,
aren't
if
doing different. So yes, whatever return is true in the aggregate is true for every individual participant, I guess, for lack of a better
As
term.
far
Yeah.
as we're concerned, we have one portfolio to manage. But everybody who's on this call is here, if you're not a guest, but if you are here as a stakeholder, you have a fractional return or a fractional interest of that return and of every year's return.
Okay. And in one of the slides previously, you had stated that there were 3 new holdings introduced and there were 3 that were dismissed.
Yep,
Is that because when they're dismissed, is that because they requested
investment
it?
reasons, investment merits.
Okay,
In other words, one of them I had talked about with the foreign investment bonds that were trading at interest rates that required the holders that were costing the holders money just for owning them. And we sold that. We thought that was a dumb proposition. That's that one.
yes,
Actually, the McCormick bond was a bond that we got when somebody created a donor advised fund. It was a very small holding. And every time we went to sell it, we weren't getting prices that were good. It had a maturity in 2021. We decided that McCormick, they make the spices that you see in the grocery stores. It is a very high quality company. We said, rather than sell it and give up something, let's just hold it. And we held it to maturity. That's generally not what we do. We generally take gifts that come in and sell them. But in this particular case, it's a sale and it was a maturity. And that's why it shows up in that bucket. And Artisan Global Fund got sold, and there was I'm going back in my memory. There was actually some kind of question regarding the manager of that fund, and there was an ethical issue that was involved. And we just said that doesn't meet who we are. And there are plenty of other funds that we can own. And we found one.
okay. Thank you.
Mhm. Anything else? Matt, I'm going to hand it back to you to wind up, or Saul to wind up. But thank you very much for the opportunity to present to you, and I look forward to doing it again next year.
Thank you, Ralph. Great job as always. And thank you all for attending this afternoon. If you have any further questions, please feel free to reach out to us. We're always available to answer questions you have. Thank you for trusting us as stewards of your investments in ECF and in the portfolio, and for our guidance and support of the nonprofit community in Evanston. Saul, you have anything you want to add to the close?
Yes, I just want to once again thank Matt, Ralph, and the rest of the investment council. It's such a tremendous gift to have all of this great work done for us on a volunteer basis. And Ralph, spoke about the cost savings of that, but I believe that the impact of that is much greater, particularly when you weigh in not only our, the investment council members providing this expertise, but also you look at Ralph, stepping up in this moment and taking on this call to explain these things on a volunteer basis as well. The true partners and supporters of the foundation in a way that we are greatly appreciative of. I also want to thank Jan Fisher, our incomparable CFO, for all of her work and making all of this work on the back end, and all that she's done to help me to understand how all of this works. And as Matt said, I want to thank all of you for entrusting us to be stewards of your resources and supporters and joining us in our support of the Evanston community. So once again, thank you for joining us. I hope you all have a wonderful evening. Not sure if it's still raining. If it is, stay dry. But yeah, just thank you once again and have a great night.